You work all month. Your paycheck says $2,400. Your bank account says $1,740. Nobody stole from you. Nobody made a mistake. Welcome to how money actually works. By the end of this video, you'll understand why your money disappears, where it goes, and how the system quietly rewards people who learn the rules and punishes everyone else. Why your paycheck lies. Taxes. You've just survived a brutal month flipping burgers at Burgo City. Long shifts. Hot grills. Grease in places grease should never be. Customers yelling. Manager watching the clock. Zero respect. You finally collapse into bed when your phone buzzes. Payday. The email says $2,400. You smile. For about 2 seconds. You open your banking app. $1,740. Wait, what? That missing money didn't disappear? No glitch? No mistake? Nobody robbed you? It was taken quietly, automatically, and legally. Federal tax, state tax, Social Security, Medicare. This is how the system works. You earn the money, but you don't keep all of it. That gap between what you make and what you get. That's the cost of living in modern society. And whether you understand it or not, you're paying it every single paycheck. Taxes, the price of civilization. You scroll through your pay stub. Federal income tax, state tax, Social Security, Medicare, line after line of money leaving your paycheck before it ever reaches you. Congratulations, you've officially participated in modern society. Taxes are the quiet subscription fee to civilization. You don't see them working every day, but without them, everything falls apart. Roads don't pave themselves. Schools don't run on vibes. Emergency services don't show up for free. And your favorite food truck doesn't magically pass health inspections. Taxes pay for the boring stuff that keeps life functioning and the expensive stuff you'll never personally see, like massive military budgets and government projects happening far away from your daily life. There are many kinds of taxes, each waiting for its turn. Income tax hits the money you earn. Sales tax hits the money you spend. Capital gains tax hits the money your money makes. Social Security forces you to save for retirement, whether you want to or not. Medicare funds healthcare for seniors and people who need it most. Then comes the real test, filing taxes. The government already knows exactly how much you owe, but still makes you figure it out. Get it right. You're fine. Get it wrong. Penalties, fees, stress. Taxes are frustrating, confusing, and unavoidable. But when managed well, they're also one of the reasons some countries offer a higher quality of life. You may not like paying taxes, but you definitely like what happens when they work. Banks, where your money actually goes. When you deposit money into a bank, most people imagine it being locked away in a secure vault, untouched, waiting patiently for them to return. That's not how banks work. Banks are not storage units. They are financial intermediaries. When you deposit $1,000, the bank does not keep all of it sitting idle. Instead, only a portion is held on hand for daily withdrawals, and the rest is actively put to work. That money may be loaned to someone buying a car, expanding a small business, paying for education, or renovating a home. This process is known as fractional reserve banking. It functions on a simple assumption. Not everyone will withdraw all of their money at the same time. Because of that, banks are able to lend out deposits while still meeting normal withdrawal demands. Banks generate profit through interest. They lend money at higher interest rates than what they pay depositors, earning the difference as revenue. This spread is the foundation of the modern banking system. So why do people still trust banks? First, digital payments and transfers make managing money faster and more convenient than cash. Second, banks pay interest, allowing savings to grow over time. Third, storing money in a bank is significantly safer than keeping it at home. And in the United States, deposits are insured up to $250,000 per depositor, per bank, protecting customers, even if a bank fails. Your money isn't sitting still. It's circulating through the economy, financing, growth, opportunity, and risk, all while remaining available to you when you need it. That's where your money actually goes. Interest. Money charging rent interest is one of the most powerful forces in finance and one of the easiest to misunderstand. Simply put, interest is the cost of using someone else's money. Let's break it down. When you borrow, interest is the price you pay. But when you invest or save, interest becomes a reward, a way for your money to grow while you sleep. That's why understanding interest is critical. It can either work for you or against you. There are two main types of interest: simple and compound. Simple interest is straightforward. It grows at a fixed rate, predictable and easy to calculate. Compound interest is far more powerful. Here, your interest earns interest. Every dollar you save or invest doesn't just grow, it multiplies. Over time, the effects are exponential. For example, a small purchase on a credit card, say a $15 snack, can become a $60 snack and become a $60 regret if you don't pay it off and allow compound interest to accumulate. On the flip side, a modest investment earning compound interest can quietly grow into significant wealth over years or decades. This is why the difference between paying interest and earning interest is so critical. Here's the rule of thumb. Paying interest? Eliminate it as quickly as possible. Debt grows faster than you realize. Earning interest? Let it sit and compound. Patience is your most powerful tool. Interest is more than numbers on a statement. It is a silent engine that decides financial outcomes. Those who respect it and put it to work for themselves win. Those who ignore it often lose. Mastering interest is mastering time and money, the two most valuable resources you have. Inflation, the silent thief. Inflation is one of the quietest forces affecting your money, and yet it impacts almost every purchase you make. Imagine walking into your favorite store for a snack. You pick up a bag of chips, but something feels off. It costs more than last month, and when you open it, it seems lighter than before. That subtle change is inflation in action. At its core, inflation is the gradual decline in the purchasing power of money. In other words, the dollar you have today buys less tomorrow. It doesn't happen overnight. There are no flashing signs, no alarms, just a slow, steady erosion that quietly eats away at your savings and your spending power. A little inflator is normal. Economists often consider 2% per year healthy. It encourages spending and investment rather than letting money sit idle. Predictable, steady inflation signals a growing economy. But when inflation spikes too high, it becomes a problem. Prices rise faster than wages, and the value of your savings shrinks. Your grocery bills climb, fuel gets more expensive, and everyday essentials feel increasingly unaffordable. This is why uncontrolled inflation is often called a silent thief. It steals from everyone, even if you never notice it directly. So how do governments and central banks respond? One common tool is raising interest rates. Higher rates make borrowing more expensive, which slows spending. Fewer loans mean less money circulating in the economy, which cools price growth. Conversely, if inflation is too low or the economy is stagnant, rates can be lowered to encourage borrowing and spending. But controlling inflation is a delicate balance. Too much intervention can trigger a slowdown, while too little can allow prices to spiral out of control. Central banks must constantly monitor the economy, adjusting rates to stabilize growth, maintain purchasing power, and protect savings. Understanding inflation is critical. It's not just a distant economic concept, it affects your daily life. The money you save, the investments you make, and even your budgeting decisions are all influenced by this invisible force. The lesson is clear: don't let your money sit idle. Invest wisely, plan ahead, and always consider how inflation might silently chip away at your wealth. Inflation is invisible, but its effects are real. Recognize it, respect it, and use it to guide smarter financial decisions. Recessions, when the music stops, recessions are one of the most misunderstood events in the economy, yet they shape the financial lives of millions of people. At their core, recessions occur when economic activity slows down for an extended period. Growth turns negative, businesses struggle, and confidence disappears. When a recession begins, the effects ripple quickly. Companies cut costs to survive. Hiring freezes turn into layoffs. Consumers stop spending on anything that isn't essential. Fear spreads, not because people suddenly panic, but because uncertainty takes over. When people don't know what tomorrow looks like, they protect what they have. Recessions don't happen randomly. They usually build up over time. One common cause is high interest rates. When borrowing becomes expensive, businesses delay expansion and consumers pull back on spending. Another cause is financial bubbles. When asset prices rise too fast in housing, stocks, or technology, they eventually collapse under their own weight. Global crises such as wars, pandemics, or supply chain disruptions can also shock economies, and sometimes recessions simply emerge from the natural economic cycle: expansion, peak, contraction, and recovery. Think of the economy like a party. At first everything feels great. Music is loud, people are spending freely, confidence is high, but eventually, the energy fades, the music slows. The lights come on, people check their bank accounts, reality sets in. That moment when excitement turns into caution is the start of a recession. Recessions are painful. Jobs are lost. Investments decline. Businesses close. But they also serve a purpose. They flush out inefficiencies, expose weak business models, and force economies to reset. Overextended companies fail, while stronger, more disciplined ones survive and adapt. History shows that recessions are not permanent. Governments respond with policy changes. Central banks adjust interest rates. Businesses innovate. Consumers regain confidence. Growth slowly returns. The key lesson is not to fear recessions, but to understand them. They are part of the economic system, not a sign that the system is broken. Preparation, patience, and long-term thinking matter most during these periods. When the music stops, those who have planned ahead are the ones still standing when it starts again. Credit scores your financial reputation. A credit score has nothing to do with how rich you are. It's about trust. Your credit score is a 3-digit number that tells lenders how reliable you appear as a borrower. It quietly follows you everywhere, influencing whether you can buy a car, rent an apartment, or qualify for a mortgage. Credit scores typically range from 300 to 850. A score below 580 signals high risk. A score above 750 suggests strong financial discipline and reliability. This number is built over time, not overnight. It's shaped by several factors: how consistently you make payments, how much of your available credit you use, how long your accounts have been open, and how often you apply for new credit. Payment history carries the most weight. Miss a payment, and the score drops. Pay on time, month after month, and it steadily rises. What makes credit scores powerful is that they influence access, not income. You can earn a solid salary and still struggle if your score is poor. Meanwhile, someone with average income but strong credit often qualifies for better interest rates and more opportunities. Your credit score doesn't judge your character. It measures predictability. And in the financial system, predictability equals trust. Whether you realize it or not, this number helps determine the kind of life you're allowed to finance. Money isn't real, but it works. Money feels solid, powerful, and permanent, but at its core, it isn't real. It only works because we collectively agree that it does. Paper bills, coins, and digital balances don't have inherent value. They represent trust. Trust that others will accept them in exchange for goods, services, and labor. Without that shared belief, money is just ink, metal, or numbers on a screen. Governments issue currency. Central banks manage how much exists. And people trade it every day, trusting that it will hold value tomorrow. That balance is fragile. If too much money enters the system, its value drops. And inflation resets, prices increase, savings lose purchasing power, and everyday life becomes more expensive. If too little money circulates, spending slows, businesses struggle, and economic growth stalls. Money is not just a tool, it's a system built on confidence. When trust is strong, economies function smoothly. When trust weakens, instability follows. Understanding this changes how you view wealth. Money isn't something you simply collect. It's something you manage, protect, and deploy wisely. Money may not be real, but the consequences of misunderstanding it absolutely are. Investing, beating inflation. Inflation slowly erodes cash. It doesn't announce itself, and it doesn't ask permission. It quietly reduces what your money can buy year after year. If your cash is sitting still, inflation is actively working against you. Investing is how you fight back. Investing means putting your money to work instead of letting it lose value over time. Rather than trading hours for income, you allow capital to generate more capital. This is how wealth is built, not overnight, but steadily and deliberately. There are many ways to invest. Stocks represent ownership in companies. Bonds allow you to lend money in exchange for interest. Funds spread risk across multiple investments. Real estate turns property into long-term income and appreciation. Each carries risk, but all share one purpose: growth. Many people fear investing because markets rise and fall. But short-term volatility is not the real danger. The true risk is leaving money idle while inflation steadily weakens its value. History shows that markets reward patience. Time in the market matters more than timing the market. Even modest investments, made consistently, can grow significantly when given enough time. The biggest financial mistake isn't losing money in the market. It's waiting forever and never letting your money work at all. Value: why some people get rich. Value is not fixed. Value is perception shaped by scarcity, demand, and belief. Gold is not valuable because it is necessary for survival. It cannot feed you or keep you warm. Gold is valuable because it is rare, difficult to obtain, and collectively agreed upon as desirable. That agreement alone gives it power. Money follows the same principle. Wealth flows toward individuals and businesses that create, control, or amplify value. The highest earners in society are rarely those who work the longest hours. They are the ones who solve meaningful problems at scale. A surgeon is paid well because health is priceless. A software engineer earns more because a single line of code can reach millions. A brand can charge premium prices not because its product is fundamentally different, but because perception increases its value. Understanding value shifts how you approach money. Instead of asking how to work harder, the more important question becomes, how can I become more valuable? How can I solve larger problems? How can I serve more people at once? Value can be practical, emotional, or symbolic. It can save time, reduce pain, provide convenience, or signal status. In many cases, perceived value matters just as much as actual utility. Those who understand value stop chasing money directly. They focus on building skills, systems, and influence that increase demand for what they offer. Over time, income becomes a byproduct, not the goal. Money is not the reward for effort alone. It is the reward for value, real or perceived, delivered consistently. Time: the ultimate advantage. Time is the most powerful asset you will ever possess, and once it's gone, it cannot be replaced. Most people trade time directly for money. 1 hour of work equals 1 hour of pay. When the work stops, so does the income. This model limits how much someone can earn, no matter how hard they try. Those who build wealth think differently. They use time as a multiplier instead of a currency. Through skills, systems, and investing, they separate income from hours worked. Time is especially powerful when combined with compound growth. Small amounts invested consistently may feel insignificant at first. Progress appears slow, almost invisible, but over years, that growth accelerates. What begins quietly can eventually become transformative. This is why starting early matters more than starting big. Someone who invests modest amounts for decades often outperforms someone who waits and invests more later. Time amplifies consistency. Time also rewards patience and discipline. It punishes delay, hesitation, and short-term thinking. The greatest cost of procrastination isn't missed opportunity, it's lost compounding. You don't need perfect timing. You need time in the system. Whether it's investing, building skills, or growing a business, longevity matters more than speed. Wealth is rarely created in sudden breakthroughs. It is built quietly, steadily, and predictably. Time is not just an advantage. It is the deciding factor. If this video changed the way you think about money, it tells the algorithm this was worth your time and worth showing to others who need it. Subscribe if you want more breakdowns like this. No fake gurus, no rented supercars, no overnight millionaire lies, just how money actually works. Because the system isn't fair, but it is predictable. And predictable systems can be learned. They can be navigated. They can be used. Once you understand the rules, money stops feeling confusing and starts feeling manageable. So, learn the game, think long term, and play it better than most. I'll see you in the next one.